everyone, this is Jennifer. So in this video I'm going to talk about the steps involved in preparation of fund flow statements. So the procedure or the steps involved in the preparation of fund flow statement are as follows. The step 1 is you're supposed to prepare the schedule of changes in working capital. Step 2 is any ledger accounts if you feel for the non-current assets or the non-current liabilities in order to ascertain the sources and uses of funds. If you need to ascertain, then you can prepare the ledger accounts. Step 3, you're supposed to compute the funds from operation from the expenses and incomes. Step 4, preparation of the fund flow statement. So let's start with the step 1. Step 1, preparation of schedule of changes in working capital. Working capital is nothing but it is the difference between your current assets and the current liabilities. It is a capital required for running the day-to-day activities of the business. So what all current assets mean? Current assets are your short-term assets of the business like your cash, bank balance, bills receivable, debtors, stock, prepaid expenses, etc. Current liabilities are the short-term liabilities of the business like outstanding expense, bills payable, creditors, bank overdraft, etc. So there is a rule for preparing the schedule of changes in working capital. The rule is when your current asset increases, your working capital increases. When your current asset decreases, your working capital decreases. So they do have a direct proportion with each other. Whereas current liability is just the opposite. When your current liability increases, your working capital decreases. When your current liability decreases, your working capital increases. So this is basically the format of the preparation of schedule of changes in working capital. You start with the current assets, you total up your current assets, then you move to your current liabilities, you total up your current liabilities. Then you calculate your working capital, which is nothing but your total current assets minus total current liabilities. Then you find out whether there is an increase or decrease in the working capital. Your step 2, which is the preparation of ledger accounts of non-current assets. So basically for identifying the inflow or outflow of fund on account of non-current items, ledger accounts will be prepared. For example, they give the opening balance and closing balance of a non-current item like a plant and machinery. So at that time we need to assume what is the difference between the opening and closing capital. So it can be a purchase or it can be a sales or it can be a depreciation, etc. So in order to find out that and add it to your fund flow statement, you prepare your ledger accounts. So example could be plant and machinery. Balance brought down is 1,20,000, which is your opening balance. Balance carried down is 80,000, which is your closing balance. So there's a difference, and they have told the amount of depreciation is 15,000. So it is by depreciation 15,000. So the balancing figure 25,000, if 1,000 is nothing but the sale of machinery. So it is by cash. You consider the balancing figure to be by cash. So when it is by cash, cash is coming into the business. So when cash is coming into the business, obviously there's some sales happen in the plant and machinery account. So it is sale of machinery. So that is how you compute your non-current assets ledger accounts. So your third step is compute the fund from operation. So you're supposed to calculate the funds from operation. So fund from operation is an important source of fund because it is the main source of profit for the organization. So it is a funds generated from the business organization. It is an internal source of funds, and one of the important source of fund is obviously the sales. So how do you prepare the funds from operation is you start with the net profit for the current year, add all the non-fund and non-operating expenses debited to the profit and loss account, and you minus the non-fund and non-operating income credited to the profit and loss account. The ultimate resultant figure is nothing but your fund from operation. So non-fund activities are nothing but which does not involve physical movement of cash, but ultimately there is an impact on the expenses or revenue. So example, if you see depreciation, it does not directly involve the outflow of cash, but indirectly there is outflow of cash because the value of the asset is decreasing. So like that, it is non-fund. Non-operating is nothing but operating means all those activities which are done by the organization which brings out its product and services, okay, or which helps in the manufacturing of product or services or the sale of product, which is the main activity of an organization. Those are operating. Non-operating are the one time activities which may affect the revenue, expenses or cash flow but fall outside the company's routine. So these are the non-operating. So you add all the non-fund and non-operating expenses and you minus all the non-fund and non-operating incomes which are debited and credited to your profit and loss account respectively. And the resultant figure that you get is the funds from operation. So this funds from operation, you will directly take it to the fund flow statement. So funds from operation can either be prepared in the statement format or in the T format. So it is the same however you prepare. So the last statement that you are going to prepare is the preparation of fund flow statement. Fund flow statement is a statement in summary forming indicating the sources and utilization of funds in business organization. So whatever sources, you debit all the sources and you credit all the application of funds. So the sources is how whenever there's an inflow of funds, it acts as a source of funds. Whenever there's outflow of funds, it acts as the application of funds. So you, for example, issue of share capital. When there's issue of share capital, there is inflow of funds. You are getting a capital inside the business, so that is a source. Application of funds, example, repayment of loans, that is outflow of funds. So whenever there's inflow, it acts as a source of funds. Whenever there's outflow, it acts as the application of funds. So in the statement of source and application of funds, it should always tally. So only when it tallies, it is the correct method of or correct way of preparing the fund flow statement. Thank you everyone.